I think one of the interesting things to come out of the crisis is around the issue of moral hazard. If you think pre-2008, there was this thinking that said, you don't want to bail out a financial institution because it will encourage more aggressive risk-taking. There'll be this moral hazard that people think they can behave however they want. In the wake of the crisis, with the bankruptcy of Lehman Brothers, you can look back and say, that may not have been worth the price we paid. So where we are today is there are systematically important financial institutions. They're under higher levels of regulatory scrutiny than they were in terms of their leverage ratios, how they use their balance sheet, how they treat their customers, how they protect their client assets. And the hope there is that in the future you'll be able to have a financial institution go bankrupt, run into difficulties, without the consequences of that cascading through the real economy, as we saw in the wake of the crisis. It's also worth bearing in mind that we're living in one of the good outcomes from the crisis. We can talk a lot about how the benefits have been unevenly distributed, about the stresses and strains that there are in the global economy today, and that's very clearly the case. But when we think about 10 years ago and the range of outcomes that we faced, there was a possibility that this would move from being a financial crisis to being something much more profound. That we wouldn't just be talking about stock prices, but that we'd be thinking about payment systems, about cash running out of ATMs, about would supply chains continue to function. Now, policymakers stepped in and prevented that from happening, or prevented that possibility. And maybe we can look back and say, well, yes, that would obviously have happened. But maybe there were a few days 10 years ago where it wasn't quite so clear. When we think about whether financial markets are safer for investors today, I think we need to draw a distinction between financial markets and the asset prices. Asset prices will still move up and down. Your capital is very clearly still at risk. Some companies will do well, some will do badly. But within financial markets themselves, hopefully what we've seen is a strengthening of those markets, a greater regulatory focus, a greater understanding from the institutions and the participants about the need to manage themselves carefully and protect their client assets.